This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and once again, we are joined today with Tom K. Wilson, who's been an investor for about 5 decades and has been investing in single families and sort of has grown into some other products. And I think first, Tom, we'll start talking about that. And by the way, welcome back to our show.
Thank you, Bruce. Always great to have time with you.
So you've gotten involved in things that I've really never done. I've bought 2 commercial buildings to occupy, but I've never done apartment buildings and commercial projects. And you've kind of morphed into these products. When did you start doing that, and how have you funded them?
I actually started in 2000 buying multifam for myself in parallel with building up a portfolio of 1 to 4s. Vernacular that maybe some listeners don't know. It means from single family homes to duplexes, triplexes, fourplexes. And I found when I was, since I had accumulated a number of houses here in Silicon Valley, 30 years later, while I was busy doing my high-tech companies, and they were going up in value. And then I studied the country to find a place where I could get higher cash flows, where they'd not appreciate as much in value, but the rents had kept up. To my shock, I found that I could sell a 1,300 square foot home in Silicon Valley for a 68-unit apartment house in Dallas. and I remember sitting down thinking, I must be calculating something wrong here. Let me go through this again. And I still have that particular product. It's my highest cash flowing product. It's a plain old Class C plus, but it's well managed in a good area. So I started buying.
Let me just make sure I got that right. You sold one house to buy that?
I sold one 1,300 square foot house, one tenant in San Jose, and bought a 68 unit without another penny.
That's a good story.
Out of my pocket.
That's a good story.
Another penny out of my pocket. That house, that multifam today is spinning off $100,000 a year. The house in San Jose would not have done that. At any rate, but to be fair, people ask, what kind of product have you had the most success from a cash flow standpoint? And I say a multifam product, and they say what's had the worst results for you? And I say a multifam. So a different one. So it's important that you pick the right market cycle and the right town and the right product and the right property manager and all of that. Absolutely, all of those. You can have all those legs of that stool. You can have a bad product and the best property manager in the world can't turn it into a princess. But if you have a really great product and a really great market, a bad property manager certainly can keep that from performing. So it's not a one or the other. You really got to have both. So back to the story of buying multifams, and I had an opportunity in 2000 after I bought my first on my own portfolio. I had an opportunity to do a condo conversion. I wasn't looking for it, but the opportunity came, and I had the resources there that I could leverage. That had done it before, knew how to do it, and we bought a 51-unit product for $2.9 million, and we put $500,000 into rehabbing it, $500,000 into marketing, and we sold it collectively off for about $5 million. So that's real dangerous when you're early in a new part of your career, and it starts to look like everything you touch turns to gold, right? Mm-hmm. So, and you can read about that in the book, and you can hear it from a Bruce Norris seminar. But there's nothing like feeling it in the gut when you make a mistake like that. So anyway, we bought a lot of multifams, and we did some syndications, but although they weren't private placement memorandums, they were mostly they were JVs, joint ventures.
Okay, and
they worked out well. But I did invest myself in a couple of private placement memorandums, and they performed okay. So I've mentioned before in our last segment valuable I think it is, and you certainly contribute to my being more in tune to that, how valuable it is to watch markets and market cycles. And it happens not just with houses in California, but it happens with all asset classes and all markets. So, I had a long run of having a lot of success with buying single-family homes and with providing them for other investors. And when it became more popular and more people were, and including hedge funds, were willing to pay more than what I thought they were worth, then it became harder to find products that were good enough, I felt, for my investors or myself. So as that problem started to escalate, I started looking for how to shift the model. I was always impressed with companies that were able to shift their model. Some don't, and they die, and the market changes. I remember in the early 80s when steakhouses became out of fashion because everybody then wanted to start going to healthier food. And most of the steakhouses went belly up. I remember Sizzler revamped all of their restaurants and put in large salad bars and offered things other than steak, and they stayed alive. So I decided that I needed to shift my business model for my company, Wilson Investment Properties, and start looking at commercial properties. And as I've already said, I had a number of, I bought many multifams. I love multifam, right? The old adage, people have to live somewhere. Of course, you need a little bit more than that to make them work. But 3 years ago, when I decided to shift the model, if it had been a little bit earlier, I probably would have focused on multifam. What I found was that the cycles were such that multifam cap rates and therefore returns were 1.5 to 2 points lower than what commercial non-multifam. Of course, the word commercial really includes multifam, but most people think of it as being non-multifam. So I found that industrial, single-tenant, industrial, multi-tenant, office, retail, so forth were having higher returns. So, and I'd already experienced that with my own portfolio of selling a $10 million partnership Class A property in Arlington for cap rate of 6 and exchanging that into 2 office and industrial products for cap rates of 8 and 9. So I had folks in Dallas where I'd had the most experience, who one in particular who had experience doing private placement memorandums and said, Tom, I think it's a model we ought to do together. I've got the I've got the sources of deal flow, and you've got the clients who are thirsty for good quality investments. Let's start partnering. So that's what we did, and we're now about to launch number 16 in 3 years. So we've got 130 million under management right now, and I've been able to progress by changing the model and by capitalizing on others who have experiences and expertise in areas that I have not.
What's the toughest thing about doing syndications for you?
I think the toughest thing is that when I'm managing other people's money, I want to be even more conservative than I am myself. I might be willing to take a little bit more risk. But when I'm responsible for others, I want to make darn sure I've covered every base that I can. I tell folks that a large part of the value of what they're getting by investing in a product that we offer to them is the 90% of the products that we spend a lot of time trying to vet that they never see, that we reject.
Yeah. You know what? I'm just going to say the same thing about a loan business. When we're offering trust deeds, people don't realize how many no answers were given before they were offered a trust deed. So what you're saying is very true. You go through a lot of projects before you finally find one that's going to make sense.
One of my sources, literally, you know him, I think, Steve Fithian. He literally gets 300 deals a day across his desk. Now, does he look and analyze at all those? No, he knows he can reject this batch and that sort of thing. But, collectively, my sources get a few hundred a day that come to them, and they quickly get funneled down to, a handful. But probably for every one that makes it through the system, there's 5 or 10 that goes into a fair amount of due diligence. I mean, we'll go, we have somebody on retainer who's a past CFO of Fortune 100 companies, and we'll pay him $2,000 or $3,000 to go do a deep dive on one of the important tenants in there, and we get a lot of no answers, and we walk away from it. But I'd say that's the hardest part, is doing enough due diligence and vetting before we offer. Of course, you always do more afterwards in the building and all that sort of thing, and deeper dive on the tenants. But you got to do a fair amount before you even offer it. You don't want to offer something, raise the money, and then after 2 or 3 times of saying, "Oh, we decided not to do that," they're not going to be too excited about the next one. So it takes a lot of resources, and I like. So we accumulate a pretty big team that has expertise in all the different areas to vet a deal.
Taking care of other people's money weighs a lot, though. It does.
It does. I take that very seriously. And, some of them who don't hit the headlines, but I think, I guess I can just speak for myself. I take that very, very seriously, and I work very, very hard to get investors the best deals and the safest deals. I have a couple of cardinal rules for my team. I think this should apply to no matter what you're buying in real estate or anything else for that matter. One is, and especially when you deal with market cycles, one cardinal rule to my team, and I must say that only one member of my team has really looked through a bear market. I'm the one that has to do a lot of the risk management. They're very smart and doing a great job, and I have to watch that. So I tell them, all right, show me what this asset class and this market did during the crash. How did it perform? Have you got the loan leverage and reserves and comfort level that this product in this market can survive another downturn? Because just assume that it will. I remember we have a number of attorneys that assist us, but one primary one that does $500 million a year worth of syndications. Mm-hmm. So I feel fortunate that I can get his time. And I said, Curtis, tell me, when we started this 4 years ago, I had our first conversation. I said, tell me something. What is the common denominator of all of your clients for success? And he said, no one's asked me that before. Let me think about it. He says, I would say that the most common denominator for my successful clients are those that have purchased a deal with enough conservatism and leverage and reserves and everything that can survive a storm. So I thought, okay, I like that. All right, I'm gonna keep that one. Like that. So I tell my team it's got to survive the next storm. History doesn't always repeat itself, but it's a good indicator. So see how it did during the last crash. And lastly, we'll get all together, and occasionally we'll get down to the end, and my God, it seems to be struggling a little bit. Do we go ahead with this or not? It got so many good points, but something just doesn't feel quite right. It's got seems to have a little hair on it that bothers me. Mm-hmm. And so I'll go around the table and I'll say, so do you feel good enough about this deal that you would feel comfortable offering it to your family and friends? And if there's a 5-second pause in the answer, we're done. That's it. We're going on to the next one.
Okay.
I think it's a good cardinal rule for everybody, right? With houses, I often say, would I feel comfortable with my daughter living here?
Oh, as far as location, yeah.
Yeah.
Okay, yeah. That's a good question. I had a series of questions. One, could my daughter live there? If I was going to flip it, it was, can my worker get out of their truck? And do they have to lock it when they leave? So, yeah.
Oh, that's good. Yeah. Yeah.
You know, got about 10 minutes left. Let's talk about our journeys to Washington, D.C. and Fannie Mae. Kind of out of the blue, I got invited to that party. I don't even know the original story of how we got there. So fill us in on how you and I have been able to go there a few times and speak in front of Fannie Mae and at least one time FHA.
Surely. I've mentioned before that I really value relationships and tapping on others who are experts in their field. So I had a guy that we both know, the name of Howard Blum, who's economist. And for a number of years, my company, Wilson Investment Properties, was providing a weekly newsletter. And that newsletter, he actually provided most of the material for it. So it was a private label, if you will. And he had known the chief economist of Mortgage Bankers Association, Dr. Doug Duncan, for a number of years. And he introduced me to him. And this was in 2007. And I said, Doug, nice to meet you. He was out for a presentation. And I said, I know this is asking a lot, but would you have any interest in be willing to come speak to our investment club? And to my shock, he said yes. So what I learned from that was that he really liked staying engaged with Main Street and the main marketplace, and not just sit in an ivory tower in D.C. Somewhere. So when he came out for that meeting, it was he had just been hired by Fannie Mae because they recognized that they're going to need to re-steer the ship, and he was at that point things had not crashed, but we learned that he was a real estate investor. He had a couple rentals, and we went to him, and after the Fannie Mae dropped the loan limit from infinite to 4, and said, Doug, I think we feel that the baby's been thrown out with the wash, and that the speculator is the one that's hit the headlines, but most investors are long-term hold folks that really didn't create this problem. I think it would be better if there were products available to investors that would actually allow us to help solve the problem and take down some of these toxic assets. And he felt like, well, that has some merit. Let me go back and see if I can drum up some interest in that arena. So it was about 3 years later, I think.
Which is about the right timetable for things to take place in Washington.
Yes. So yeah, it's like a cruise ship, right? It's like pushing on the side of the bow to get it to change direction. And lo and behold, I thought I was forgotten. I stayed in touch with him, and he'd been out again to speak. And he said, just be patient. It takes a while there in D.C. And I had worked for years in high tech. Some of those years were with companies that provide products to the military. So I had a sense of how slowly government can operate. But one day I got the call, and he said, Tom, I think I've got an audience for you. And I said, and then my heart sunk, and I thought, oh my gosh, I'm going to go back. And I know a little bit about it from my experience, but I don't know nearly enough. I like to leverage others that they're more knowledgeable than I am. So you got my first call, and Sean O'Toole got my second call, and you both said, well, when do we hop on the plane?
Yeah, that was fun.
Yeah, that was fun, and that was. I remember the remember the staffers apologizing that they didn't have limos for us. We were just stuck in the big black Suburbans. You remember that? Going from one place to another. Things had really tightened up in D.C.
Now,
but we certainly got an audience. But I think we agreed that the attitude was it would be nice and we'll talk about it. But they weren't entirely sold, and they were more concerned about how they could help out investors without losing political capital, about helping rich, with the perception of helping rich people get richer.
Right. Now, this last meeting seemed very different to me.
Certainly did, yeah.
What was your take on the difference between the two audiences?
Well, I don't know if it was more how the market has changed or how Doug had done a good job of continuing to lobby for us investors. But certainly when we got the call in last year of November to come out for a dry run, and then again in December to come out, and to our shock, there was an audience of 60, including 20 VPs, and the CEO sat right up front. Just from that alone, it was clear things were different. They were serious, right? And I felt they were extremely receptive to our input. And then when they came back from their breakout groups, they had really, really good questions. And I thought we made a really good team, because I went there kind of talking from the investor perspective of what we want to be able to buy more homes. And you came from the perspective of having a real tangible experience of what it was like to loan to investors. And they were shocked to find what a low, almost, zero default rate you had after deploying, $70 million or something like that?
Yes. What was, I think my favorite part is they were actually listening. I didn't feel
intently.
Right. It didn't feel perfunctory at all. It felt like when they went into those groups alone and came out with questions, they were really listening to our answers. And because we had a lot more experience than them, it was just, honestly, it's just a lot of fun to go to bat for our industry. And if if anything comes of it someday, that'll feel really good.
It really will. And was honored for you to engage and go with me, Bruce. Thank you very much. Felt like I was, you were the one with more direct experience, but I thought we made a good team, and I think I think they got value out of our visit. Yeah,
and Doug has been a friend to our industry. He really has, and it's been nice for him to support the I Survived events. He's been out there sometimes where he's leaving the next morning at 4 a.m, where people are still talking to him at midnight. He's been very generous. That's been really cool.
Yeah, certainly has. And he's told us that out of the 100 events he speaks at a year. Can you believe that? that I Survived is his favorite event. And our first meeting that we went out to D.C., that was, that's when I had the pleasure of introducing you to him. And before he left, you had invited him to I Survived, and he's been there every year.
Tom, what's your website? I'd like to have people be able to go there.
Thank you. TomWilsonProperties.com. And we haven't been running quite as long as you have, but we've got 5 years worth of radio shows on KDOW and podcasts with such notable folks as Bruce Norris and Doug Duncan and Robert Kiyosaki, and a lot of nice guests like you do. And I just love, and it's not commercially oriented or pitching anything. I just love finding people who are really experienced and sharing their knowledge and education with others. So TomWilsonProperties.com. And for those that might be interested in some diversity of investments, for most of what we offer, you have to be signed up with us, or we have a weekly newsletter you sign up for in order to get opportunities to buy into syndications. That's just the way the SEC works.
Okay. Tom, have a Merry Christmas, and thank you for joining us once again.
Thank you, Bruce. And thank you again for being a great partner back there in D.C. and for all the time that we've shared together. I value it significantly.
Okay. Thanks a lot.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.